It does seem as though investors are very worried that the bond markets are sending some warning signs here about a potential looming recession. Are you worried?
No, I think the fundamentals for the U.S. economy are still quite strong. I think the labor market is strong. I think the consumer, on the strength of good employment prospects, is strong. And I'm looking for growth this year to be 1.75% to 2%. That's a pretty good growth rate, actually, because I think of trend growth rate in the U.S. is 1.75%. So I think that the U.S. economy is poised for continued growth. I do realize that people are nervous about the risks. After all, the Fed just said that we're going to pause with our interest rate setting. We're going to look at the data and see how the economy plays out. There are risks, slower growth abroad. The fiscal stimulus is waning, but I still think fundamentals are good.
If that is your view, do you agree with the median forecasts of the dot plots that there will be no rate hikes this year, or do you still think it is likely that we could see an increase in the federal funds rate?
To get my forecast for 1.75% to 2%, I do assume a modestly accommodative stance of monetary policy. So I actually assume that the funds rate is not going to need adjusting until the fall of 2020. And even that would require me to see inflation to move up, as I expect in my outlook. I see inflation rising above 2% on the strength of good policy accommodation, which would be unchanged policy. That's important for it.
What would you say to investors who predict the next move coming from the FOMC will be a cut?
I would sort of ask why they think that's the case, and I would expect them to say that they think there might be a shock that would take growth down. I think if growth continues the way that I'm expecting, there would be no reason to cut rates. I think that the inflation outlook, I'm a little nervous that underlying inflation is just a little less than our 2% symmetric objective. We're pretty close to 2%, but I think sustaining that probably requires a little bit more lift. And so I think that pausing to assess the inflation and the growth prospects is going to give that a better chance to go a little bit above 2%, which I think would be useful.
What would you say to the reaction that we saw with the inversion of the yield curve? The stock market reacted one way, fixed income yields reacted in a different way. What do you make of that?
I think we have to be a little bit nervous, obviously. Whenever the yield curve gets flat, we see growth decelerating. And like I say, I'm looking for almost 2% growth this year. Now that sounds kind of low, but it's actually relative to trend of 1.75%. It's a good growth rate. I think anytime the economy decelerates from 3.1% down to 2%, it takes a really sharp-minded focus to kind of go, all right, it's less than what we had, but it's still pretty good. Your first reaction is kind of go, wow, this is less than what we had. And I think that's sort of missing the message. So I think it's not inappropriate for everybody to be careful and cautious about where the trajectory is for growth. I think it's still good, but I can understand why there'd be more watchful waiting and looking. After all, that's what the Fed's doing, and I think the data will prove it out.
Hi, I'm Emily Tan, and thanks for watching CNBC. You can check out more of our videos by clicking on the boxes on the screen, and don't forget to subscribe to the channel for more. Thanks for watching.